Welcome to the program. My name is Marty Shenkman, and I'm joined by colleagues and friends, Jonathan Blotmacher and Robert Keebler. And we're going to talk about a topic that I think is a little different, but hopefully very practical. And depending what happens in Washington, and Bob tells me we may know soon, or maybe we will know, I don't know. The topic is on Spousal Lifetime Access Trust. Everyone knows the acronym SLATs. But we're going to try to talk about how to adapt SLATs in a practical way for clients that are not really concerned or facing an estate tax. So the mass affluent, which we talk about, is really a large part of many practitioners' client base. We're going to talk about SLATs for that. But if the exemption, a bonus exemption, stays at the current high level, then a larger swath of clients may not be worried about estate tax. And if they repeal the estate tax, no clients are going to be worried about the estate tax, well, at least until it's reenacted. So we're going to talk about something that's a very practical application of a technique that I think everyone's familiar with, that will hopefully help all of us expand the scope of services and clients we can serve. So with that little introduction, let me get started. The webinar will be posted to the Peak Trust Company and ILS website, as well as my own. We don't give CLE or CPE, but a certificate may be sent, and we can't control those if you don't get one, so forgive us. Our two sponsors are Peak and ILS, and I'm going to turn it over to Teresa to tell you something about ILS.
Great, thank you, Marty. Yes, Interactive Legal is pleased to sponsor today's presentation, and Marty already alluded to this, that we are anxiously awaiting proposed tax legislation, and I know that either this group or a similar group of speakers will jump on another webinar as soon as we get some of that proposed tax legislation to talk about what it means, because then we have to think about what might we need to do in revising our documents. Interactive Legal, of course, is a provider of automated document assembly programs. We used to call it software, but now it's web-based, so you can draft from anywhere with an internet connection. Our wealth transfer planning program is designed for high net worth estate tax planning. Our elder law and special needs planning system is designed for clients who need Medicaid or VA planning or who have special needs beneficiaries. But in all of our systems, you can draft SLATs. So if you need more information, you can reach out to us at interactivelegal.com. And I am looking forward to the presentation. I'll turn it back to you, Marty.
And just, I'm not going to plug ILS specifically, and I'm not, an official plugger for ILS, but the kind of planning that we're talking about, I'm not sure how you can cost effectively do it without document generation software. I know it's now web-based, but without document generation systems, because you need the efficiencies and the flexibility to take a technique that was really conceived of for wealthier clients looking to save estate tax and make it robust and applicable and helpful for clients of much lesser means. And those clients at lesser means are often going to pay less. You need that efficiency to do it. We'll point out some of those aspects as we go. I don't think we have any ILS screenshots, but if there's an interest, we could do a follow-up program and actually show how to draft it if people are interested. But you really need to make that move if you haven't to document generation software, whichever one you use. And obviously, I use ILS, but you need that capability. So thank you, Teresa. And Jonathan, do you want to just mention Peak?
Sure. Peak Trust Company is a full-service trust company with offices in Alaska and in Nevada, and probably soon at least one other place. I've been involved with Peak since its beginning in 1997 in Alaska, although I don't own an interest in it. My brother was the president for a number of years. Now my nephew Matt, whom I think the world of, and I think many people also think he's just a great guy. Andre Sears is, whose beautiful picture is right here, is the business development officer. He's a great guy. And, it's not because I'm related to some of the folks that work there, but the vast majority of my family's money is with Peak. They are really a great provider of trust services, very, very flexible, have great people working there. And if you want trust services, whether it's a small account or an enormous account, I think you ought to give Peak a try.
And in the context of this specific webinar, the analysis of do I use an institutional trustee and when I use an institutional trustee is different than many of the programs we've done where I've said you really want to use and only use an institutional trustee. Based on the Levine or Levine, I'm still not sure how to pronounce it, split dollar case, the court made a point of saying how it valued and recognized the independence that an independent institutional trustee provided. So for wealthier clients and more sophisticated tax-oriented planning or asset protection planning, I routinely encourage clients to use an institution. Here that we're going to talk about it because I think the analysis is different. When you have a more moderate wealth client, you may not want to use an institution initially and give a trust protector the power to make a change to an institution or a better jurisdiction at the future to keep the initial cost down, but we'll talk about that. I think before we get started, I made a really quick introduction, Jonathan, that perhaps you can and Bob can both elaborate on a little. And, you know, whatever tax legislation is proposed, that doesn't mean that's going to be what's ultimately enacted anyhow. So, you know, we're going to still have some uncertainty for a while. But maybe just give a little talk, a couple of comments, Jonathan, then Bob, about the environment we're in, what you might anticipate, and why robust, flexible planning makes sense now.
Well, Marty, it really does, because we simply don't know what's going to happen. And even if we get a proposed bill, it will be changed somewhat before it's enacted. And even when it's enacted, it will probably change. Keep in mind that ever since 1986, we have had enormous changes in estate and gift taxation, including the introduction of the generation skipping transfer tax. When I first started practicing, the estate tax exemption was only $60,000. The estate tax rates were 77. Many states had an add-on estate tax, which in places like New York brought the top rate up to 82%, and that was on amounts above $10 million. Now, if you take into account inflation, 10 million is now about 100 million, but still an awful lot of people out there would just be aghast to think that 77 or 82% of their wealth is going to go above $100 million. I know that Bob and Marty would worry about that if it came to pass. I mean, it's just a different environment. And one of the things you have to do is to be flexible. And we're going to talk about that and why a spousal lifetime access trust will greatly add in many circumstances to what you're trying to achieve in estate planning, which is asset protection for yourself, for members of your family and other loved ones, for businesses, for example. And it also is to save taxes. It's not just taxes, but it's all the other reasons why assets may be vulnerable to attachment or attack. Remember, there are an awful lot of creditors and predators out there. In fact, just the other day, I got a call from one of the institutions I work with, which said that one of my accounts had been compromised, but they were smart enough to be able to figure it out, which, Marty, is one of the reasons, again, why you want to use a good corporate fiduciary on the team. Because if you have your brother-in-law, your sister, whoever in there as the trustee, they may not notice that you're going to go ahead and have a problem with someone trying to break into an account. People lose billions of dollars every year. So you want a good, strong, sophisticated corporate fiduciary. So please take that into account. You can negotiate. If you have a large trust, you can negotiate the fees. Even if you don't, you can shop around, but please get a corporate fiduciary, at least in some role in your planning.
Bob, any comments on our current environment?
Very dynamic, and we have to take into account a 60-year-old could easily live 25 to 35 years. And
could we say longer?
Sure, we can say longer, but many people that will be members of Congress by the time a 60-year-old dies probably haven't been born yet. And so there's no way to predict what the law is going to be. The SLAT gives us a tool to remove property from your estate while leaving your spouse as a beneficiary. So that's what we'll talk about today.
Well, and also let me add, it's not just making your spouse a beneficiary. It's because you can become the beneficiary if you set it up the right way, and we'll talk about that. But a SLAT, once you create a trust for the benefit of your spouse, if you do it the right way, it's going to be immunized from your spouse's creditors' claims and from your creditors' claims as well. Extremely important. In fact, more money is lost each year by claims of creditors than taxes when it comes to the estate planning world.
And we're going to talk about that in a little more depth because, and Jonathan kind of spilled the beans ahead of the slide we're going to have on it, but asset protection is something that is absolutely critical for any client of any substance. And the mass affluent client, 10 million and under, doesn't mean that those are inconsequential sums of money. And whatever the wealth is their wealth. They want to protect it. And they don't often do the protective steps with the same to the same extent that wealthier clients do, and that's one of the purposes of this program. I want to ask you both about one piece that I thought you would both say, but you didn't, and to me, it's a major motivator for why even the mass affluent, the lower wealthy clients below the exemption amount should look at SLAT type planning. And I'm saying SLAT type planning, even if I don't say the word, that's what I mean, because it could be adapt, a hybrid adapt, or something else, which we'll talk briefly about. But my concern is, okay, so you're only worth $8 million, as if that's inconsequential. For a lot of practitioners, the 10 million and under client is still a pretty meaningful part of their practice. If the administration changes with the next election, and it may change at the end of, with the congressional election, but certainly at the presidential election, the next round, or the round after that. But at some point, the pendulum swings the other way. I would be pretty confident that if there's a Democratic control over Washington, they're going to enact something along the lines of a Bernie Sanders or Elizabeth Warren wealth tax, estate tax, et cetera. We could have an exemption back to 3.5 million. I mean, to me, that's an important reason. It's not the emphasis of this course, but that's an important reason why clients under the exemption level, clients 10 million and under as an example, should still plan. Any comments or thoughts on the potential more long run?
The
Oh,
pendulum,
Marty, go ahead, Bob.
the pendulum will swing, Marty. That's the only thing we know about U.S. politics. And at some point in time, it could swing back. So I think we deal with what we have, but we should, be ready for, a lot of times we'll do a barbell analysis for clients so they know what happens under various circumstances.
And notice that President Trump has even come out and said, well, maybe the rich should pay more tax. And so I don't know whether it's raising, the top rate from 37 to 38% or more. But it may be that the estate tax or things related to estate tax planning will also be hit with more. There's just an awful lot of publicity about the rich just not paying their fair share. And someone may decide that the way they can kind of put solve on everything is to make the rich, in fact, pay more.
So, Jonathan, or Bob, either, why don't you give us just a quick overview of what a SLAT is? I know everyone understands it, but let's just set the table with a 1 minute quick overview to explain it so everybody's on board.
Well, let me start, Bob, and you can help me here. A SLAT, a Spousal Lifetime Access Trust, which, by the way, the first time I read about this, the guy who wrote the article on it called it a Spousal Limited Access Trust because he felt that in order to avoid having it come back into the estate of the grantor, not the beneficiary spouse, you had to limit the kind of access the spouse would have or distributions that could be made. So he was saying you basically got to put in an ascertainable standard like health, education, support for the spouse for whom the trust is created. Otherwise, it may come back and be your estate. Mitchell Gans and I wrote an article to the contrary, and without criticizing the author, pointed out that wasn't true. But the concept of creating a trust for your spouse makes great sense. And here's why you want to do it. It will not qualify for the marital deduction. So you're going to be making a completed gift, and you'll be using your exemption, which today may be very good. Remember, the exemption's now about $14 million. And if you haven't used it all, this is one of the ways you can use it. And even though you may say, well, aren't I giving up anything? Well, maybe you're not, because if you have a good relationship with your spouse, you can go ahead and basically provide for your spouse to get distributions, or for the trustee to make loans to your spouse. And yet it will not be in your estate or in your spouse's estate, which is something good. And one of the things you need to worry about is, well, what if my spouse and I get divorced? And we'll talk about that, right, Marty?
We will talk about that.
We will talk about that.
Let's just give the high, quick overview.
Right.
Bob, any other?
You're creating an irrevocable trust for the benefit of your spouse. Generally, it will be discretionary. And by the way, it doesn't have to be for your spouse alone, because it's not going to qualify for the marital deduction. It could be for your spouse and other people, like your siblings or your children or your grandchildren or something like that. But you want to have it in there for your spouse, because through your spouse, you can continue to get benefits from the trust. And that's the critical thing. Yet by putting it in trust for your spouse, it should not be subject to the claims of her creditors or the claim of a new spouse of hers if she remarries after you die.
Bob, any introductory comments?
No, I support what Jonathan says, obviously, but I just think this is one of the most important planning techniques. And Marty, you said something very stunning. I want to say it again. The dollars lost to creditors exceed the dollars lost to estate tax. And everyone is naturally, the estate tax is kind of a certainty, right? If you're worth more than the exemption. And the creditor issue is very hard to put your mind around, but any one of us can find ourselves in a creditor situation pretty easily, not through a professional malpractice, but just driving your car, et cetera, et cetera. So I think this structuring is basically twofold. One, to save tax, and B, to protect property you've worked hard for, to make sure that property goes down to your children and your grandchildren.
Quick comment on usage. In the examples, and when I speak, I'm going to say husband, wife. It's not to make a political statement, but I just find it too confusing to say spouse one, spouse two, and remember what's going on. So I'm not going to do that. And even though we're talking in the context of married couples, if you're single, all these concepts can apply in a self-settled trust. If you don't have a spouse, but you have a sibling, a friend, a partner, the same kind of planning can apply. There's just no marital deduction, but as Jonathan said, you're not trying to get it. So let's not get hung up on any of the verbiage, because we're just trying to focus on the concepts to help. Now, the first thing, and the most typical application of SLATs, is not for the mass affluent clients, the clients below the exemption, which is our topic today, but it's really for wealthier clients. And I'm going to just breeze through it quickly, because I want to leave time for Jonathan and Robert, Bob, to talk about the asset protection and the income tax planning and the other benefits this technique affords besides estate tax. The only reason I want to run through this quickly, and I'm sure you all know it, but just again to set the table for anyone that may not be familiar, because this concept was really developed as an estate planning tool to use exemption and to make married couples comfortable doing planning to use exemption when they wanted to have access to their assets. So I'm just going to use that as an example, because that'll help us. That'll be like the contrast or the touchstone by which we compare SLATs for lower wealth clients, which is our concept. So I'm going to go through this really quickly. There's more detail in the slides. I don't want to belabor it. If clients don't use their exemption and the exemption declines in 2026, which doesn't seem likely to happen, but that was what we've been talking about for years, then they will face a larger estate tax. If a client wanted to use exemption, the concern for, and I don't like the phrase in this context, but I'm going to use it, moderate wealth clients, and it's only moderate relative to the very high exemption, because $28 million puts you in a very wealthy category in terms of the wealth strata. But if the client doesn't have access, they couldn't make the gift in many cases. So those moderate wealth clients would use a SLAT where the spouse could be a beneficiary and they could gain access indirectly through the spouse. So if I have a SLAT and my wife has desire to go on a cruise, she could take me because I'm married to her. My wife could have the SLAT that I create for her buy a vacation home, and so long as I'm her husband, I would have the right to use it. That is indirect benefit. Caution has to be exercised because if those indirect benefits are too are agreed upon ahead of time, are too significant, a creditor or someone else may challenge it. So that's the concept of a SLAT. And as I say on the bottom of page 10, there's nothing wrong with doing that. We've all done lots of that since 2012 especially. But it's still a very limited sort of one-dimensional perspective on planning. In the right circumstances, still great. But when you have a client that's under the exemption amount, there seems to be no relevance to a SLAT. And the whole point of this program is to say yes, but you can adapt that technique and tweak it for other benefits that are really valuable to a moderate wealth client. So you want to look at the other benefits. We're going to talk about those. You also have to have more efficiency to keep the costs lower so that this type of planning is palatable to those clients. And we're going to talk about that as well. So the key question, slide 11, is how can this tool, SLATs, which is a powerful planning technique that has been used, I guess, guys, it's fair to say ubiquitously in planning. I mean, it's been just like, the foundation of so many estate plans. But how can we adopt this and marshal all these benefits for other clients that are at a lesser means? And that's what we're going to talk about.
Marty, let me make a couple of points here. Bob mentioned it a lot of time. And I mentioned that, basically, if you go back to 1976, the value of the dollar has dropped by about 90%. And that also means that if you set aside a dollar in 1976 and you had reasonably good investment performance, you'd have $10 today. I mean, think about that. So if you have a client who says, well, look, I'm only 50 years old, I only have $3 million, why should I worry? Well, keep in mind that if you make only 7% a year, your money will double in 10 years. It will quadruple in 20 years, and it will increase by eightfold in 30 years. So that 50-year-old will probably live to 80. And instead of having $3 million in his pocket, he's going to have something like $100 million in his pocket. Keep that in mind. And that should be a motivation, again, not just for taxes, but for asset protection as well.
Let me emphasize what Jonathan said with a slight spin for the mass affluent, the lower wealth client. Jonathan just made a very cogent argument why people that don't need to worry about the estate tax today may have to worry about it tomorrow. And the other component of the may have to worry about it is something that Bob and I just said, the pendulum swings. So right now, Republicans control Washington, and it seems we thought that any increase in taxes would be unlikely, but as Jonathan explained, that's now on the table too. There's no certainty at all what might happen. If we have a $3.5 million exemption 10 years from now, and that client with $3 million and it keeps growing over time, certainly over the long run, this planning may make a world of sense for them. The key to this type of client, you can't lead with that as a sufficient rationale to do the planning, because for many of those clients, what Jonathan and I just described seems too remote. It's still a benefit that I think, and I agree with Jonathan, makes a world of sense to talk about, but we're going to emphasize the other aspects of planning because those will apply more currently and with more certainty to the mass affluent client. So how do you start to adapt? I have a case study. Bob, do you want to go through it or should I just go through it?
So let's just keep going, Marty, please.
All right, you and Jonathan feel free to interrupt. So John and Jane Smith, they're both physicians. Well, they're obviously worried about malpractice claims. They're in their early 40s. They have a young child. They have a couple million in non-retirement savings, and they're very concerned, again, about malpractice risk, as they should be. Many younger physicians and others concerned about malpractice, which goes way beyond physicians, are hesitant to engage in asset protection planning because until they have something facing them, they don't see the urgency of it. And that's something that we need to guide them to assess and understand. They also need life insurance to protect themselves and their young children. So right away, we'd be thinking a life insurance trust, but hold on. They're not worried about estate tax, but after hearing Jonathan's comments, they acknowledge that down the road it could be an issue, and they do understand the exemption could be reduced in the future, even if the Republicans repeal the tax. Remember 2010, it came back. Jane's mother is in her 90s and not doing great, and they help her out financially. Important point. We're going to come to that, and I'm going to have Bob talk about basis step-up planning. So under your guidance, John and Jane create two non-reciprocal SLATs. We'll talk briefly about non-reciprocal SLATs. They have to be sufficiently different. It'll come up a little later on the slides. We're not going to focus extensively on that because there's lots of programs that we've done and others have done about non-reciprocal SLATs. The trusts are created in their home state. Now, when I normally create SLATs, my default SLAT plan, and I say SLAT-like plan because it could be DAPT and hybrid DAPT and so on, is one trust in one jurisdiction like Nevada, another trust in Alaska, South Dakota, Delaware. There's now 20 states that have DAPT jurisdiction. I like to have separate institutional trustees in two separate jurisdictions because I agree 1,000% with what Jonathan said about using institutions. It's just the better default approach for a variety of reasons, especially professional management, but also the courts and IRS will view it differently. And I like having trust-friendly jurisdictions because why not take advantage of better law? For the moderate wealth client, the cost of getting co-counsel in another jurisdiction, the cost of paying an institution, even a lower priced administrative institution, could well be an impediment to their going forward with the planning. So what I've suggested on slide 13 is even though my preference and my default would be let's use an institutional trustee in a trust-friendly jurisdiction like Delaware, we may start with two different trustees in the home state because of the difference in cost. But what I would do, and especially apropos to this case study with two physicians, is I'd have a trust protector who has the authority to change situs governing law, remove and replace a trustee. And I wouldn't wait for one of them to have a lawsuit. As soon as they feel that their income has grown enough and their wealth level has grown enough, I would have the trust protector move to a better jurisdiction if they're not living in one, and name an institutional trustee in each of that jurisdiction, and probably have the spouses move to another jurisdiction. And for young physicians, as an example, as their income grows, they can make that move. I wouldn't wait for a claim to arise because then it's kind of late. But nonetheless, even if a claim arose, having a trust protector being able to make those moves and get it out of the jurisdiction and get a non-family independent trustee may be helpful. So I'd appoint a trust protector. And when I said earlier in the program how using document generation systems is important for this kind of planning, this is an example. You know, whether your standard trust form has trust protectors, not trust protectors, etc., it's very inexpensive, very efficient, and very quick to add these types of provisions, whether it be a trust protector or any of the other things we're going to talk about when you're doing document generation, using a document generation system. And by the way, the other thing, when you draft with document generation software, it prompts you to think about all these additions. So if you're not thinking of should I have a loan power, should I have a power to add the grantor as a beneficiary, a hybrid DAPT, should I have the ability to add a charitable beneficiary or other, and I'll let Jonathan talk in a few minutes about other beneficiaries that could be helpful from an income tax planning perspective. You're prompted to think about that when you use document generation. So keep all that in mind. Now, a primary goal of this couple, which is true for so many couples, is to have as much access as possible to the funds in the trust because right now they're young. They have a long runway. They could live another 50 plus years. Who knows what the future can be 20 years from now, let alone 50. And while they're still in the wealth accumulation phase, they're going to be more concerned about not having access. So within the confines of whatever home state law is, I would give them as many options to access the trust, hoping that they don't touch any of the trust money for many years to come. And some of them, like the end of slide 13, you may not use until after the trust is moved to a better jurisdiction. For example, if we set up a hybrid DAPT, which could add the grantor back as a beneficiary, if you're in New York, which doesn't permit self-settled trust, I wouldn't do that until you move to Nevada, which does permit it. So just a thought. Now, Bob, why don't you explain the basis step up and the GPOA that they could give to Jane's elderly mother and how that could help them in a few years, regardless of the estate tax? Because that's an important, I think, incentive that will entice many much more moderate wealth clients to do this type of planning.
Well, we start with, he creates a trust of where his mother is a beneficiary, along with potentially his wife, his children. And we grant the mother a general power of appointment. Now, a naked general power of appointment would include in her estate, and because it's included in her estate, the black letter law under section 1014 is there's a step up. That's easy. You would probably draft a formula power, Marty, so that you didn't inadvertently cause an estate tax for his mother. But let's say her estate is worth 2, his exemption is 14. She would have a $12 million power of appointment. And that would include 12 million of that trust in her estate.
Which is way beyond what the trust has. So you got a basis step up on everything.
A basis step up on everything. And at the heart of it is he now has a stepped up basis. This is a very good, solid plan. Now, some people use this, basically give their mother a GPOA and have her not really be a beneficiary of the trust. What I'm most comfortable with is that she's an income and a discretionary beneficiary with regard to principal, and that we actually give her some money along the way. Maybe not a lot. We transfer some money from the trust to her.
I love that idea, by the way. And if it's $1,000 quarterly, she can't say, no one in the IRS can't say she didn't know about the trust, that this was a sham. Now, I know the case law seems to suggest she doesn't even have to be aware of it, but for the modest cost and effort of giving a small distribution, why have that issue? But the key point, just to reiterate, you've now taken a technique, the SLAT, you've combined the GPOA basis planning, which some SLAT plans have, many don't, but using that planning technique for the moderate wealth client, you're in effect saying to them, I know you're not worried about an estate tax now. I understand that you appreciate down the road it could be helpful, so we're going to do it. But look at the benefit you're going to get near term, which is the elimination on the capital gains on all that NVIDIA stock that you're putting into this trust. It's huge.
It's a big advantage, and we probably should be doing more of it.
The next item on the list, and Jonathan, you can comment on insurance. Even for moderate wealth clients, insurance is even a more important part of their planning in many cases than for wealthier clients, because if there's a premature death, that insurance proceeds, the proceeds from that policy or those policies, could be critical to the financial security of the family. Now, many young families will go out and buy a term policy. And I'm not, Jonathan, you can comment if you want on types of coverage, but I'm not going to comment on that. But the common planning tool, because even if it's just a term policy, often clients get $1 million, even moderate wealth clients, $1 million, $2 million or more of policy coverage, because if there's a premature death of one of the breadwinners or both breadwinners, that money is going to be essential to care for the surviving spouse and for the kids. If you create a SLAT, you don't need to set up a separate insurance trust. The SLAT is really similar in most respects to an insurance trust. It just would tend to have a more robust powers and provisions. What I do when I create most of the slats that I do, and I wish I had thought of this years earlier, is I automatically include insurance provisions. I always either name a separate insurance trustee or build in the ability to add an insurance trustee. And the reason I do that is most slats that I see, if there's a family business or rental properties, the client, the grantor, the settlor wants to be the the investment advisor so that they can be responsible for those non-marketable investments. And if you use an institution, they don't want to be involved, generally speaking, or they will charge a more handsome fee for being involved with non-marketables. So you build in the insurance provisions. With document generation systems, it's clicking a button and putting in a name of a trustee, an extra trustee, and if you don't have a person or client doesn't have a person to name, you can give the power to the trust protector to add somebody later. Jonathan, do you want to comment at all on insurance in this context?
Yeah, I mean, insurance is one of the most important things that can be considered, especially by a young couple, because if one of them dies, the family's income will be cut probably by more than half. Because not only do you only now have one breadwinner, but duties and things like that will fall even more heavily on the survivor, which means the survivor may not be able to spend as much time in generating income for the family. So it's critically important to consider it. It won't cost any more to have insurance provisions in the trust, so you should have it in there. Now, one of the things that you want to consider is you do not want the insurance proceeds included in the estate of the insured. And if you follow pretty basic rules, that's relatively easy to accomplish.
And you do it in the same trust. You don't have to sell a moderate wealth client a multiple trusts. One of the, and I don't mean this in a negative way, but one of the because we don't want to sell clients, but one of the advantages to help clients understand, to make them want to accept this kind of planning, you got the basis step up we just talked about. You don't need a separate insurance trust. Those dollars, if a God forbid happens, are protected just for your spouse and kids. No new spouse, no creditor's going to get them. That's an important advantage. And again, with document generation software, it doesn't take any more time or cost to create a much more robust trust plan than a basic life insurance trust. And you may look at other types of coverage if they're putting assets in the trust. So for example, if a young couple is putting a material percentage of their wealth in a trust, maybe they should reevaluate what they're doing on disability. The last line on slide 14, let's say Jane puts $500,000 in her trust, John puts in 650. How much they put in should really be, I think, backed up by some financial modeling to show that they have money to live on. In a lot of cases, the younger couples and even midlife couples that are doing that would be appropriate for the SLAT planning for the mass affluent, they still have salaries or income or earnings from their business that is covering living expenses. So you can do that. Now, John and Jane have a valuable asset protection plan because they have money in a SLAT. They put in not all of their wealth, but a meaningful part of their wealth, and they had some financial modeling to do it. They have insurance coverage, and they have the analysis done by the insurance consultant to show how that works. The couple, which is very typical, had talked to their attorney about having trusts for their children or 529 plans. There's no reason, I mean, they could still do a 529 plan, and Bob, you can mention in a second some of the income tax savings, but trusts for the children are really not necessary at all. Because if you do what Jonathan said a few minutes ago and you create the SLAT to benefit the mother or mother-in-law, whoever you're doing the upstream planning for basis step up with, and you include all future descendants, it includes the children, why create another trust for the children? So you've eliminated trust for kids, you've eliminated an insurance trust, you're getting an income tax basis step up, you're having asset protection benefits, and if their estate grows using the compounding that Jonathan talked about, wasn't it Einstein who said compounding is the eighth wonder of the world?
Yep, he did.
So this is already, to me, look like a really valuable plan. And what we've really done is taken the typical SLAT and just really looked at all the other benefits and make sure that it can be provided in this plan. Bob, you want to mention something about 529 plans and why it still may make sense And I think we've covered enough the basis step up on Jane's mom's passing, so I don't think we need to address that further.
Well, for parents or grandparents creating 529 plans, the general rule is you get the assets out of your estate for estate tax purposes and for creditor protection. And the icing on the cake is all the growth is income tax free. So you combine those three things, these are pretty easy things to do.
You can't beat the income tax benefit. So in the context of SLAT planning, while I wouldn't set up I would generally not set up, unless the client really wanted it or there's a reason, a trust for the kids, or a trust especially for each kid or grandkid, because they're all beneficiaries under the SLAT. The client still may benefit from doing 529 plans. One, it's another bucket for asset protection, but two, as Bob pointed out, the growth is income tax free, and that's hard to beat. So one of the points on SLAT planning is that a lot of the SLATs that I've seen, and Jonathan, I'm sure you and Bob have both seen them. Some of them, many of them are very plain vanilla and don't include a lot of the stuff that we've just talked about. I don't see basis step-up planning with GPOAs or any of the many variations of it in most of the SLATs that I see. Most of them are fairly standardized. So some of the bells and whistles, especially for the more moderate wealth client, could be very important. And that's something to think about.
Let me mention one thing here, Marty. If you're going to do that upstream planning where you're going to try to use the exemption of another relative whom you anticipate to die first, remember, if you have to make a gift to get it in a trust so that the family member will be able to have a general power of appointment over it. So you're going to have to make a completed gift in order for your older relative to be able to have a general power of appointment pulling it in his or her estate. So you need to think about that. I'm going to have to sacrifice part of my exemption in order to allow my mother-in-law, my aunt, or something to be able to get the benefit of a general power, which would put it in his or her estate. Keep that in mind. It's not absolutely free. You will pay a price, which is using your own exemption to get it in there.
But for the moderate wealth client, they're not really worried about using the exemption because their estate is sufficiently below that threshold. But it is important, but that's why, and this is kind of, Jonathan is highlighting the point I'm trying to make, and maybe I didn't make it very eloquently, so forgive me. But the typical SLAT may name a spouse as a beneficiary, and it's really focused on using exemption. But for the mass affluent client, they got to be able to have access, just as Jonathan was indicating. If you're going to make a completed gift, you have to know that you have access to it. Otherwise, the planning doesn't work. And there's lots of ways that we can build in that planning. And Jonathan, I'm going to come back to you in a minute. Let me just run through a couple of these slides and have you talk about some of the ways to access it and how you can enhance it. And that's why I said earlier I used the phrase SLAT-like, because DAPs, hybrid DAPs, and SPATs, which I'll let Jonathan talk about in a minute, are other variants of the same kind of planning that may make more sense, because a client with lower wealth level has to have more access in many cases to have the financial security to do the planning. So we've talked about estate tax uncertainty, growth of estates, compounding, and the potential for changes in the future administration. Income tax benefits, we talked about the basis step up, but there's another potential income tax benefit that, Bob, I'm going to let you talk about. Jonathan and you and I have written a lot about this with using non-grantor trust. Bob, talk about the non-grantor trust aspect, because I think while the default approach to a SLAT is it's a grantor trust, that doesn't have to be the case. And for somebody living in New York or California, any of the other high tax states, talk to us for a minute and help people understand why they may want to evaluate with their client using a non-grantor SLAT.
Very simple. Your client lives in California. He moves $13,990,000 into a trust for his wife. We structure that with the right appointment committee, so it's a non-grantor trust. All of a sudden, California will not tax that trust until those dollars are returned to California, and then they impose a throwback tax. But if I do that right as a completed gift to a discretionary Nevada, Wyoming trust, Alaska trust, I'm no longer subject to annual California tax. California won't tax that until the beneficiaries receive a distribution.
How much can that add up to over years? And keep in mind, our hypothetical was two young physicians, so they're living, barring some tragic health or other issue, they're living for the foreseeable. Not only are they living for the foreseeable future on their income, which will grow, but they're going to continue to save money as they build for their retirement. And to the extent they've maxed out on qualified plans, they will use annual gifts, not annual exclusion gifts, but periodically make new gifts of new assets to this non-grantor SLAT to save state income tax. How significant can that be for 20 or 30 years, Bob, before they retire?
You can run the numbers, but for New York, California, Minnesota, those high tax states, literally it can add up to millions of dollars of savings. And you have to keep in mind that you don't know where the beneficiaries are going to scatter to. And the grandma and grandpa could be in California, but children and grandchildren may have already left the state. And then there's no way you want to give California the right to tax that for the next 25 or 50 years.
Jonathan, I know we did something after, I think, the 2017 Tax Act on salty SLATs, but non-grantor trust to secure deductions. But just from an income tax standpoint, do you want to make any other comments to add to what Bob said?
Well, let me just mention to make it clear, if you create a trust for your spouse, Section 677 is going to say it's a grantor trust, which means that the income earned in the trust is going to be taxed to the grantor spouse, not the beneficiary spouse, and not to the trust itself, but back to the grantor. However, if you create a trust for your spouse and you provide that distributions can be made to that spouse only with the consent of an adverse party, then it's not going to be a grantor trust. It will be a separate and independent entity, which means you can get the benefits of having another taxpayer. Now, if they're all in lower brackets, that may not make sense. But if each of the couples has, $500,000-$600,000 of income, which a young physician may have, the income inside that trust, even though it's going to accumulate and possibly be paid to the beneficiary spouse, you don't have to pay, have that income attributed to the grantor. So again, if it's a couple in New York, California, Oregon, Minnesota, one of these high tax jurisdictions, but you place the trust in a place like Alaska or Delaware, where there's not going to be a state income tax, that can be an enormous advantage.
So just to recap, we talked about basis step-up planning, and now we've talked about the potential income tax benefits of using a non-grantor SLAT. Some call it a SLANT. There's other acronyms. It doesn't matter. But a non-grantor SLAT, you do need, exactly as Jonathan said, the approval of an adverse party to make a distribution to the spouse. And you have to be very careful. You can't have, you don't want a loan made out of a non-grantor trust, because if it's to the settlor and it's below market, inadequate interest or inadequate security, you've now triggered a grantor trust status. It takes some care, and that's beyond what we're going to do today. But the key point is you now have two very potentially powerful income tax planning. You can avoid state income tax. You can income bracket shift with different family members as a non-grantor trust. And then you have the basis step up. Those income tax benefits alone, which is often not the focus at all as SLAT planning, could very well alone not only justify, but make the client thrilled that's mass affluent, that's not worried about an estate tax, just from these income tax benefits alone. And there's some more information there. Jonathan, I'm in your camp where asset protection is absolutely critical, and lots of clients well below the estate tax exemption amount should have and should do asset protection planning. Do you want to comment any more or any further on the asset protection benefits of this type of planning?
Well, Marty, the only thing where you can really protect the assets from creditors is with a trust. That's the strongest thing we have in all of United States jurisprudence. So if you want to have great asset protection, you've got to use a trust. Now, there are some states where it won't work as well. New York's a bad place, California's a bad place, but there are lots of states where you can go ahead and be able to create a trust in that jurisdiction. And under the laws of that state, unless you were trying to defraud a creditor when you created it, a known creditor at that time, it will be completely immunized from claims of creditors. And again, in many of these states, you can create the trust for your own benefit. It's just a critically important thing to think about.
And taking that kind of planning benefit to the clients below the exemption level is critical to protecting them, and something that many of them should be thinking about. And again, and I'm sorry if I'm repeating it too much, but I just think it's very important for these clients where estate tax is not an obvious benefit, but it could be long-term, and that's not a great motivator to do the planning. But you have all these other different benefits that we're trying to emphasize, which too often in traditional SLAT planning don't get talked enough about. They're all there for the taking. And I think you can do this kind of planning in a way that's incredibly helpful to lots of other clients. Just very quickly, anytime you put money into assets into a trust, even a revocable trust, you can provide some protection from aging and for infirm clients. Having assets in an irrevocable trust as the clients get on in years, you've already created the structure for all the other reasons we've said. It's a nice way to protect assets from the vultures that prey on aging clients for identity theft or elder financial abuse. Especially, and what Jonathan stressed, now's the time to do it. You have an aging client, get an institutional trustee, get professional trust management. They're going to do the kind of job of paying attention. And Jonathan gave an example of this earlier on. They're going to focus on whether an account is compromised. They're going to catch a lot of the financial abuse that a family member is going to be oblivious to. So I don't know that I would call that a major reason to do this planning, but boy, it's a great opportunity to expand the planning. I've already said this, so just very quickly, with all that we've talked about, you don't need a non-grantor trust to save state income tax. You don't need an insurance trust, an asset protection trust, a trust for kids, a dynasty trust. The SLAT planning can do all of this. And by the way, you probably don't want, although I've seen it done, insurance in a non-grantor trust. But if you're doing two SLATs and one's non-grantor and one's grantor, the grantor trust could hold the insurance, the non-grantor trust could be doing income tax planning. And boy, that certainly should address the reciprocal trust doctrine, because now you got some very different profiles on those true trusts. So what is some of the tailoring that we can do? And I want to just make sure we get through some of this because we only have about another 10 minutes to make a SLAT that you would have typically done for a wealthier client using exemption. What do you do for the mass affluent or the lower wealth client that's different? So one of the things is cost is an obvious factor. And again, as I said earlier, using document generation system software can help you really tailor a SLAT and include exactly or as many of the different options for income tax planning or access very cost effectively. Another point, home state versus DAPT. My default approach, which I think is the better approach, if possible, if the clients will agree, is to put each SLAT in a self-settled trust jurisdiction: Alaska, Nevada, Delaware, South Dakota, the four common ones, but there's 16 other states that can do this, and use an institutional trustee. In this context, you may use a home state trust, and you may name a family member or friend or a lawyer or an accountant, whatever, as the trust protector, and give them or trustee, and give a trust protector the right to move it. Keeps the cost down. Clearly, we always encourage financial forecast and insurance reviews, but I think for these clients, that's even more important to do, to make sure that the trust plan makes sense for them and they understand the overall planning. We've talked about the power of appointment for an elderly beneficiary. Jonathan, we don't have a lot of time, but maybe just comment briefly about reciprocal trust, because even for these types of clients at a lower wealth level, even though we're not so worried about estate tax, we do want this to work. Maybe just comment quickly on that.
Well, this actually appeared before the concept of the reciprocal trust doctrine for tax purposes, where, in fact, the first case involved two Lehman brothers, each of whom created a trust for the other brother, but the tax court held and the Second Circuit agreed that we were going to treat the trust that brother A created for brother B as though the beneficiary, brother B, had created the trust. And that doctrine has now gone to the Supreme Court in a case called the State of Grace, in which the Supreme Court said, yes, if husband and wife create trusts for each other, they're going to be uncrossed and each will be treated as though he or she created the trust. Keep in mind that if you make the trust sufficiently different, you may be able to avoid it, but you want to get them done as different in time with different assets, different trustees, and as Marty indicated, even different governing law to make them quite different. So that's one of the things that you can do. But please be aware that that doctrine exists and you don't want to be caught by it because it will just terminate everything you've been trying to do.
Jonathan, if I want to make sure I have some material differences between these two trusts, but I'm really time and budget conscious because it's a lower wealth client, and while we're giving them all these income tax and asset protection benefits, it's still a harder sell and they're more cost conscious than a client that is convinced that they're going to save millions in estate tax. If I'm using document generation software, how does that make it easier and more efficient for me to differentiate the two trusts?
Well, because you will be given options. For example, when my wife and I created trusts, we created them a year apart. I gave Betsy tremendous powers in the trust. She was an immediate beneficiary. She had a lifetime and a testamentary power of appointment. She could change trustees. I couldn't do any of that in the trust she created for me. The best thing you can do is to have you create the trust for your spouse, but don't even let your spouse know you've done that. And then the attorney can go to the spouse at a later time and say, it would be appropriate for you to consider creating a trust for your husband. That's one of the best things you can do. The alternative, and maybe we can come to it now, Marty, is one of the spouses doesn't create a trust for the other spouse, but creates what I call a SPAT, a special power of appointment trust. For example, I create a trust for Betsy. Betsy doesn't create a trust for me. She creates a trust just for the benefit of her kids. And in fact, the trust prohibits making distributions by the trustee to either Betsy or me. But Betsy names 3 people whom we trust, who are given lifetime powers of appointment in a non-fiduciary capacity. Basically, these are power of appointments. They're non-fiduciary, and each of those people can appoint the property to any descendant of Betsy or of mine. Those are not going to be reciprocal trusts because I created a trust for Betsy. She didn't create a trust for me. The law is very, very clear. If you take a look at the commentary to section 505 of the Uniform Trust Code, you will see that if you create a trust and the trustee can never give the grantor any property back, it's not subject to the claims of creditors. So those are some of the things you can do. And that way you're going to have, your 3 best friends who can give the property to you. You can have 5 if you want, and you can allow them to name successors.
Let me just amplify really quick a couple of points on what Jonathan said. With document generation systems, you can literally click spouse 1 trust, spouse 2 trust, and it can automatically, bam, bake in what are probably more differences than many attorneys use between the non-reciprocal SLATs they use. So it can make this drafting really efficient and simple to do. Another point that Jonathan said, which is really important, when you're dealing with clients worth $50 or $100 million, they may still kind of want a SLAT. They maybe want a loan provision, but they're less in need often, not always, depends on spending levels, of access. The moderate wealth client, the access could be far more important. And that's why using some of the alternative techniques, when I said SLAT-like, for a wealthier client, you could do 2 non-reciprocal SLATs. For a really wealthy client, maybe no spouse has to be a beneficiary. For the moderate wealth client, making one a hybrid domestic asset protection trust where someone can get added back as a beneficiary, or the SPAT that Jonathan mentioned, which is arguably more secure than adapt because you're never a beneficiary. But these techniques that are more than just a SLAT, the SPAT or hybrid adapt, may be really important for this level of client. And again, with document generation systems, it's not that hard to add in these extra mechanisms, and that benefit may be really important for these clients. Let me run through a few more points on that. The differences that we talk about building in, we have to remember as practitioners, those differences are real. And Jonathan said the D word earlier. What if the couple gets divorced? Well, if Jonathan made himself the case study, I'll use it. If Jonathan and his wife got divorced, she has far more access to the money in the trust he created than he has to the access to the trust she created. Jonathan may be all for that when the lawyer's drafting it, but may not remember that until something happens and then be very unhappy. Oh my, I didn't realize I'd have so little access. I think it's important that when you do the differentiation, you do point out to the clients that those things are actually real and could have significant impact and meaningful uh, uh, effect on cash flow to each of them.
Now, Marty,
Um,
let me mention one other thing. You create a trust for your spouse, and unless you make it, only can receive it with the consent of an adverse party, it's going to be a grantor trust with respect to you. Now, if you and your spouse get divorced, and she can still be a beneficiary of the trust, and unless you put in the requirement that it can only be distributed with the consent of an adverse party, you're going to go ahead and have to pay the income tax even after you and your spouse are divorced. I mean, that's just a terrible thing. So one of the things you have to do when you do a SLAT is to provide that if the couple breaks up, however you want to define it, either the spouse is no longer a beneficiary, can no longer receive distributions, or you have to put in that those distributions can only be made with the consent of an adverse party to turn grantor trust status off.
Lots more planning on that. Let me just mention another couple of points. And again, I'm trying to emphasize some of the things you may do different in a SLAT for the mass affluent than for the wealthier client. Now, we always use swap powers, but again, flexibility given the uncertainty, as Bob and Jonathan explained with the tax law, the ability to get an income producing asset out in exchange for a non-income producing asset. I think for the moderate wealth client, that swap power is even more important. Include a tax reimbursement clause because it could be critical for their cash flow. You can't count on adding it later. There was a CCA that recently came out where the IRS was arguing there was an imputed gift. So think about putting in the tax reimbursement clause right away. I'd have an express loan provision. I'd have an express provision for decanting. You want to bake in flexibility. Access is key. The proper insurance coverage is really important for the mass affluent client. I like the idea of an independent insurance consultant going over disability, life, long-term care, all these coverages, whether the clients wanted it before or not. The fact that they go through that analysis will help assure that they understand the economic risk. And a lot of the economic risks of this planning, especially for the lower wealth client, can be mitigated with insurance planning. Whether they choose to do it or not is their choice, but I like them to have the option. Jonathan, we're getting short on time, but I would like you to comment briefly about beneficiaries, even if it's very brief, and even this concept of special beneficiaries, whether it be an S Corp, charitable trust, just
Well,
for flexibility.
Well, yeah, Marty and I wrote an article entitled "The Flexible Beneficiary Trust," which appeared in Estate Planning magazine, and it means that you really have to have your trust be very, very flexibly drafted. Get that article, look at it. We actually offer language which you should put in every trust where you're allowed to make discretionary payments. That's the bottom line.
Gives more access, more flexibility, better options to deal with the uncertainty they may come down the road, which is more significant for the moderate wealth client than the others. I would permit adding charitable beneficiaries if it's a grantor trust, because if you can add a charitable beneficiary, it may help the client address charitable giving that they want to do that they didn't think of now. And that's another form, if you will, of access. Provisions to make loans. Here's a sample loan provision courtesy of ILS. That's the special beneficiaries. We kind of cut through it quickly. We've talked about more access, the DAPT, self-settled trust, the hybrid DAPT, and the SPAT. And again, the point of all of this is you want to maximize flexibility. You want to maximize access, especially for the more moderate wealth client, because they're more likely to need it. Now, one of the things, and I just had this conversation with the client, every access point, what I said was every additional access point I give you may help give you peace of mind financially and ensure your financial security, but each additional access point may come with some additional incremental risk of either estate inclusion or a creditor reaching it. I think you should point that out. I think we're getting to the end of the line. I think we've covered all the topics that we wanted to. Jonathan, why don't you try to sum up why practitioners should think of using these types of trust for lower wealth clients as well, and what they might want to do differently?
Well, it provides great flexibility, it provides asset protection, and it puts them in a position to get great estate planning if the need should arise.
And Bob, just reinforce the income tax benefits we talked about, because I think that's often off radar, especially for estate planning attorneys. And it shouldn't be with this type of planning. It could be a really huge benefit.
Well, we're focused on three things: asset protection, estate tax protection, and possibly reducing income tax. Reducing the income tax would start with your general power of appointment idea, where the 95-year-old gets the GPOA contingent, because that could give you basis increase. But also more commonly, people in states like California would reach outside of California, create a Wyoming or an Alaska or a Nevada trust. And what they would accomplish is deferring or potentially totally avoiding the California income tax.
Huge benefit. Thank you all for joining us. To me, one of the take-home messages is while clients are fretting or frustrated with the complete uncertainty of where the tax system may go, that ain't changing, because no matter what's done now or in the next year or two, it could all change yet again. How many times have we had conversations on webinars or, at conferences where, oh my, where's it going now? But the kind of emphasis that we tried to bring you today is you can take the sophisticated estate tax minimization, use of bonus exemption planning in a SLAT or SLAT-like trust, and you can make it cost-effective and efficient and apply it in a robust way to make it beneficial for lots of clients, which is, I think, better planning and work for lots of our clients, and good business for all of us. So I hope the ideas work. We welcome any thoughts or input that you may have. I want to thank Jonathan and Bob for their insights and their comments, and I hope you find this of some help and practical use. Good luck, everybody.
Thanks, Marty. Thanks, Jonathan.
Thank you, Bob. Thanks, Marty.
Take care.